Hey everyone, thanks for joining the December webinar. For those of you who don't know me, my name is Ashley and I'm on the Investor Relations team. Today I would like to introduce our new Director of Investor Relations, Daniel. Daniel, if you could just take it from here.
Good afternoon. Again, my name is Daniel, new Director of Investor Relations here at Equity Mobile in our headquarters here in New York City. Joining me today, we'll have Milan Parekh, Senior Director of Real Estate, Charles Andrade, Associate Director of Real Estate, and Charles Kurtz, another Associate Director for Real Estate. And they're both, all three on our real estate team. And they'll go through some of our open offerings, give some economic commentary, and then we will be taking some questions at the end. So with that, I would like to get into the current macro environment and hand it off to Charles Andrade to go over some of the economic backdrop and the real estate overview.
Thank you, Daniel, and pleasure being here with you as well as some of our investors here today. So we'd love to spend a bit of time talking about the macro environment. Obviously, as many investors are aware, we're continuing to see persistent pressure through several geopolitical factors, which we believe merits taking a closer look at the strategic investment or long-term asset allocations as well as diversification. So I'd like to start today by highlighting 4 different data points, and then we can get into our outlook on real estate with my colleague Milan Parekh and the other colleague Charles Kurtz as well. So on inflation, as many investors will be aware, core inflation, which is actually the measure excluding energy and food, has been the Fed's historical focus point over the widely published CPI. And core inflation has recently actually started to decelerate on a monthly basis. It's still at a significant sort of 6% year over year as of this month. That's coming down from a high of about 2 months ago where it was about 6.6%, which was a 40-year high. So that's definitely positive and a sign that things are moving in the right direction. And so while this outperforms recent analyst expectations and the outlook is starting to improve, we do still expect inflationary pressure to be a key factor going into this upcoming year. And so the inflationary pressure really gives rise to the rising rate environment that we've all been experiencing. And so this has put continued pressure on the Fed to raise rates. And the pace of rate hikes this year has been unprecedented. It's really sort of been behind only the aggressive rate hikes that we've seen in the early to late 70s and 80s, which obviously is commensurate with us breaking those records this year. But on a positive note, the rate hike pace is starting to slow as we see sort of more of those positive inflation numbers, signaling that we are potentially past the peak that we've set earlier this year, with the rate of the Fed rate currently at 4.4% and expected to reach a 5.1% terminal rate or max rate over the course of next year. And so both the inflation as well as this raising rate environment give rise to sort of some shift in the correlation aspect in terms of portfolio allocation. And so the continued macro and geopolitical factors that we've seen really have pressured the rationale behind the so-called 60-40 portfolio, the traditional allocation portfolio, as that diversification benefit between stocks and bonds is distorted through that increased correlation. And so one of the key factors behind that is really inflation. And so for the first time in a long time, and for the first time for some investors, sort of personal track records, we're seeing that sort of correlation move from the typical negative correlation that we've seen sort of throughout the 90s into that territory, which is denoted here on the right-hand side in the green area of the chart, which is a positive correlation, which we haven't seen really since the 70s, 80s, and early 90s. And so that positive correlation fueled by the inflation has essentially eliminated a significant portion of the traditional rationale behind the stock bond diversification and sort of is causing that distortion in portfolio level that we're seeing. And so I think nothing is more evident of that than the 60-40 portfolio performance over the course of this past year, which if we can go to the next slide, David, as evident here by the portfolio tracked by Blackstone. Actually, sorry, previous slide, David. The 60-40 portfolio is down close to 20% for the first 3 quarters of this year, and actually for the first time ever has had negative quarter-on-quarter returns for 3 consecutive quarters. And this quarter's performance, with about 2 weeks left to go in the year, has only solidified those numbers, and so it could very well end up being 4 quarters of down performance, and pretty much the worst year ever for a 60/40 portfolio. And so that's really, I think, the best example of what has been happening to sort of distort that 60/40 dynamic and the diversification benefits. And so I think those 3 factors essentially lead us to recommend revisiting your strategic asset allocations and really looking at long-term approach to asset allocation from the perspective of infusing alternative investments, as these sort of low or non-public correlated investments can help offset or mitigate some of these factors. And that's not dissimilar to how institutional investors have looked to allocate, in particular, endowments and foundations, but more recently also pension and insurance funds, allocating 10 up to as much as 40 or 50% of their portfolios in towards alternatives. And so alternatives don't just include real estate. They span private equity, hedge funds, as well as real assets. And obviously real estate is a key component of that. And here at Equity Multiple, we have a particularly well-positioned platform where we offer investments through both different sectors as well as across strategies. And so really allow our investors to capitalize or basically compose a portfolio that helps mitigate or hedge some of these factors and concerns that as sort of we expect to at least deal for a number of months still. And so with that sort of shift in strategy, we'd like to bring in my colleague Milan Parekh, and we can highlight some of the investments that we're currently offering and some of our thoughts around real estate investments over the next few quarters, and help our investors basically build a better portfolio to be more resilient for these geo and macro political concerns.
Thanks, Charles. While he did a good job of explaining why this is a good time for alternatives, I thought I'd spend a few minutes just talking about what we're seeing in the in the real estate capital markets world right now. What has happened over the past few months and what we expect kind of going forward. So, as Charles alluded to, right, the government has raised rates at a really fast clip to stop inflation, to help lower inflation. What that has meant on the real estate side is, very high cost of capital to finance transactions and acquisitions. And that has really slowed down transaction activity because sellers, don't really, want to take that hit on pricing, and has led to, a pretty sizable, what we call a bid-ask spread. And you've seen a decline in transaction activity. And I think going into Q1, that's going to kind of continue to be the case. But given some of the positives we're seeing with, inflation trending down, the Fed signaling, continued rate increases, but at a, smaller clip, what that's going to lead to is, I think, just a settling of the unknown and less volatility. And I think, both buyers and sellers, coming to more of a alignment of expectations. And, as this chart shows on the screen here, right, and, valuation, kind of a direct correlation of interest rates and cap rates. So, in short, we do expect cap rates to increase slightly along with interest rates, but we do expect that spread to get tighter and have a more frothy transaction activity as we go into kind of Q2 and forward. Now, in terms of where we still see opportunity from an asset class perspective, we are still very much bullish on the industrial asset class. In preferred markets, vacancy is still, call it sub 5%. There is a lack of new supply, and we still see strong trends on the rental growth rate. Similarly, on multifamily, while we expect rental rates to not grow as fast as they did over the last 2 years, there's still a housing shortfall and a need for apartments across the country. And then especially in your stronger kind of secondary and tertiary markets, we think there's a lot of opportunity still. Storage as well, It's a very recession-proof, type asset class, and it caters to, both positive growth trends on the housing front, multifamily, and the real estate as a whole. So, we see opportunity there. Hospitality as well. We're starting to, come back to, especially on the leisure side. Hospitality is basically the best bet when you're looking at an inflation hedge because it's the shortest duration leases. We're seeing, occupancy pick up at, on the hotel side, and we're seeing an ability to drive rates, and you're seeing, lenders come back to that market. So optimistically, we will be bringing, I think, more hospitality opportunities to the market next year. And then, lastly, given kind of the volatility and some uncertainty with valuation, we also see an opportunity in structured products, and specifically, preferred equity and high yield debt, where there is a retrenchment from senior lenders, lowering their leverage thresholds as it relates to coverage and debt yield. There is, creates an opportunity for groups like us to provide, stretch financing or preferred equity, where we still get the benefit of, a reduced cost basis. We're senior in the stack, but we're able to still, achieve, call it low to mid-teens returns on stuff that was probably 300 to 400 basis points lower in 2020 and 2021. So with that, maybe we'll dive into a few specific transactions that we're offering to the marketplace today.
Awesome. So thank you for Charles and Milind going over the market. As you'll see in the next couple slides, we've got three key deals that we'd like to go over. Just as a reminder, our team screens dozens of deals each year, and just about less than 10% of those transactions ever make it onto the platform. So really highlighting our due diligence there. And really, we'd like to highlight three very different but key drivers on these deals. Again, these may provide some diversification to your portfolio, but definitely you should always keep in mind the risk and return that you're looking for, as well as doing a full due diligence for yourself. And with that, I'd like to hand it back to Milind to discuss Orland Park.
Can we pull up a slide on Orland? Thanks. So this is a great example of a deal where, we've been talking to the sponsorship here for over a year. We really like their operational expertise and their focus on, 1 to 2 core markets, primarily in the Metro Chicago area. This deal specifically is an acquisition of 16 townhomes that's part of a larger kind of mixed-use master plan residential community that was built in 2019. Why do we like this asset now? Our sponsor has, tied this up in a quasi off-market transaction, buying from a seller that is, dealing with some liquidity issues and is, kind of forced to sell right now. So our sponsor not only negotiated a pretty attractive price, but as interest rates have risen, was also able to negotiate some significant price reductions that make for a very compelling, both cash flow play and upside here. So there is the seller here has not been managing the asset well. So there is a kind of immediate mark-to-market opportunity on the rents to increase those approximately 20% without really doing much capital improvement. And there was a light capex plan here to improve some infrastructure and some cosmetics, but really this is an operational play where we can drive rents and frankly put in better management to run this more efficiently. So we're acquiring this asset at approximately a 6.3 cap rate going in with accretive leverage, which is rare right now. The interest rate on the debt is approximately 5.7%. This is going to generate, immediate cash flow day one. And given kind of the smaller unit base here, we think the sponsor can, drive its business plan, push rents, and really kind of stabilize the asset in 2 to 3 years. After 3 years, we have flexible prepay on the debt, and that's where we're targeting to exit this transaction. Especially, we'll have more time for kind of markets to stabilize. Rates are expected to go down in kind of the 2 to 3 year plan. So we think this should be an attractive exit in that 2 to 3 year hold period, and we expect returns here to generate approximately 19% net IRR, just under a 2x multiple, with an average cash and cash of 5%. As always, if you guys have questions on the transaction, feel free to type them into the chat, or follow up with our IR team after as well.
Thanks, Dylan. So I'm here to talk about our next offering, Express Car Wash. This is a really interesting opportunity for a number of reasons. I'd like to start with a little bit of background first. So this deal is a participation in a senior loan on a to-be-built car wash just outside of central Los Angeles. The original loan, which has a total funding proceeds of about $5.5 million, was originally closed in April 2022 by an affiliate of EM. And with the use of internal leverage, EM is actually offering a junior participation in that same senior loan with a much increased target rate. So the target rate on this deal is 11%, which we think is incredibly attractive given the attractive basis here. And again, we're able to do this using an internal leverage, which I think provides returns that are market right now, given kind of, as everyone's talked about, the high interest rate environment. So I talked a little bit about the basis. We have an appraisal that was ordered by EM back in April for the completed project, and the loan to value on that appraisal is 51%. So extremely low, again, given the high target rate here. A little backstory on the project. It's another reason why we think this is such an interesting opportunity, is that a lot of the work has been done already. The total construction timeline is quite short, given it is a car wash. And so the structure that the sponsor actually has to build is quite minimal. And a lot of the hard part of that is pre-development. So getting the permitting, getting all the right uses in place, doing your horizontal construction and all that. And at this point in time, by the closing of this investment, virtually all of the pre-development process will be fully completed, and the project will be shovel ready to go. And because of that, the projected timeline of finishing construction and getting operations off the ground here is kind of early or during Q2 2023. So we're really looking at a 6-month actual vertical construction timeline, which is much shorter than your typical pre-development, full development timeline. The plan here for exit is to get refinanced or to sell the asset upon stabilization of the property. So once it's built, it will be operated as a fully operated express car wash, which is a hybrid between automated and kind of manual car washes. And we expect this to take about 9 months to 12 months after finishing construction for the investment to be taken out. And you have plenty of room on a potential exit, assuming that the sponsor is able to get cash flow going anywhere near our projections. The sponsor here is extremely experienced, especially in development and especially in car wash locally. It's a group called STG Capital. They've done over $250 million of total construction development. Again, most of which is in the greater Los Angeles area. And one of their principles that they brought on specifically for this project and to expand their car wash pipeline in general has over 20 years of development experience on car washes, which again is a major plus for us given the specific use of this asset and how much of the value is tied to said use. Another thing to mention, I think, is just the quality of our opinion on the quality of the car wash space in general. Equity Multiple has fairly significant experience in the space. We had a portfolio of 6 car washes where we were a preferred equity provider in 2020 and 2021 that were kind of located throughout the Southeast with the same operator. And we were able to exit that portfolio with a very nice return earlier in 2021. And we're constantly, because of that portfolio received kind of news in the space. It was pretty buzzworthy. We've had a lot of new operators and developers come to us as potential capital partner for the car wash assets, and it's an asset class we're constantly looking at because of that as well. So in the event that something were to go wrong, we believe in our expertise to be able to either bring somebody in or finish the project ourselves because of that. And then the numbers support that as well. The car wash industry is expected to grow at an additional 3.1% between 2022 and 2023. And we really like it, especially on the senior loan side, because of how cash heavy of a business it is. Your costs are very fixed by getting the equipment in place. And then once the equipment's in place, your costs are very minimal to actually operate the wash. And it's very sticky asset class in recession as well. People always seem to need to get their cars washed, no matter what the economic conditions are going on. So we're really excited about this opportunity. Currently, we're offering about a $1.1 million allocation, but that's subject to increase in future closings as the loan continues to get funded. As of so far, about $2.4 million of the $5.5 million loan that I highlighted earlier has been funded in the project, with additional draws expected to come up in the next few months. So it's one that you'll likely see on the platform again once those draws are done. So if you do happen to miss this early allocation, which I know is getting a lot of demand, there will be other opportunities for you to invest as well. With that, I'd like to pass it back to Charles to talk about our next deal.
Thanks, Charles. So I wanted to spend some time talking about the Pods industrial portfolio here. This is a $5.5 million allocation in LP equity investment for the opportunity to acquire the Pods industrial triple net lease portfolio. These are two assets across multiple buildings spanning approximately 154,000 square feet in Tampa, Florida, tenanted by Pods, who are a moving and storage company. The sponsor here is Ultimate Realty, which is a group that we know well. It's actually a three-time repeat sponsor who recently actually realized the prior distribution center investment that we offered here at Equity Multiple in the Hartford, Connecticut Last Mile Center, which came out to a 55.8% IRR and a 2x multiple. And we have successfully invested with them earlier this summer, actually, in the Orlando Last Mile Distribution Center as well, which is performing well. And so I would actually like to reference our investors to the offering page for the Pods portfolio, where you can find a more detailed Q&A and webinar, which is currently live as well, giving you a bit more background on both those transactions, as well as Ultimate Realty as a sponsor, and obviously the Pods portfolio. So specific to this investment, one of the factors that we particularly like is the compelling mark-to-market opportunity in a tight Tampa industrial market. So for this portfolio specifically, across the two buildings, rents are at 25 and a 52% discount to average market rates across the two assets, with a weighted average lease expiration of approximately 20 months. And so that really offers our sponsor the ability to, at release or lease renewal, capture the upside by resetting the rates to market rates, and in part also capture the inflation that we're seeing nationwide and in the local market. And so obviously offsetting some of the inflation concerns that some of our investors may have. In terms of fundamentals, Tampa has been a very strong market as well. Rent growth in the market has been strong, especially recently, and is forecast to grow by an annualized 5.8% through 2027, while available space remains very limited in the market. And for this particular investment, our sponsor is underwriting an exit in 3 years' time, which should make for an attractive exit, given that the sponsor will at that point have realized the mark-to-market upside with minimal CapEx spend, and projecting ultimately to reach an approximate 20% IRR full net to EM investors. We further like the fact that the Pods tenant are an institutional grade and credit rated tenant, as well as the overall quality and location of the asset itself. Pods specifically were founded in 1998 with over 250 or so locations nationwide, which really sort of helps support their moving and shipping sort of oriented company. So Pods are essentially a modular moving company where you can rent a sort of modular container, if you will, and move your goods from location A to location B, as well as utilize that container for some short-term storage. And so as such, it has a sort of counter-cyclical nature to it. So it's not your typical industrial tenant, which is actually one of the factors that we like in particular about pods. As I mentioned, pods are further institutional grade, credit rated, which given the net lease nature here is a benefit as well. And then specific to the assets, the buildings themselves are fairly recent. They were developed in 2004 and 2007, and they were actually purpose-built for pods, and they serve as their key locations in this market. The purpose-built element specifically speaks to the specific size and clear height demands that pods have in terms of storing their containers and utilizing the space to manufacture some of the containers as well, and make it challenging essentially for pods to find suitable alternative space, especially in a market which has been as tight and sort of as limited in space as the Tampa market. So we feel that there's overall a high likelihood for pods to renew their lease and do so at market rates, and obviously help the sponsor realize the upside that they're underwriting. The assets themselves, aside from being fairly recently built, are further in great condition, requiring minimal capex, and ideally situated and connected to all of the major thoroughfares throughout the sort of Tampa MSA, which makes for sort of a further highlighting or attractive aspect of this investment. And then as we are working with the sponsor towards close, I actually wanted to take the opportunity today to end on a positive note or preview almost an interesting update with our investors. So the sponsor has actually been working with the seller to negotiate a purchase price reduction, which will have a meaningful impact to the underwritten return. So that approximate 20% return that I mentioned, we're expecting to hopefully be able to share a positive update here shortly that will be even more appealing. And so once finalized, we'll share that with our investors. But I think overall, this showcases both these sponsors' expertise. They've done extensive amount of deals in the Florida market. It's a market and environment that they're very knowledgeable and comfortable in. And it also shows their resourcefulness in terms of continuing to drive and try and extract and deliver as much as valuable as possible to both our investors as well as the investment itself. And so really excited about this opportunity and looking forward to share an update here with investors shortly.
Awesome. Well, I'd like to thank all three of our real estate professionals for joining us and going over each offering. Again, encourage you all to ask any questions in the chat. Drop them in that box right there on the screen. Just as a quick overview, each of these deals has a specific investment minimum and a target return. Orland Park and Pods each have a $20,000 investment minimum, with Express Car Wash being a $10,000 minimum. Both Orland Park and Pods are equity deals, and Express Car Wash is a debt type transaction with 11% net investor target return. With that, I'm just looking at our chat here and seeing if we have any questions. Looks like we have our first question regarding the car wash portfolio. When are monthly interest payments expected to start for the car wash loan? And is Equity Multiple the only senior lender on this deal? I'll send it over to Charles Kurtz for that one.
Thanks. Yeah, it's a great question. So the first, I guess, it's a two-part question. First part, are when are monthly interest payments expected to start? The answer is immediately. We have a pre-funded reserve, which is highlighted in the offering, about $300,000 just for our interest piece. And so the deal has been paying interest since it originated in April, and that reserve is expected to last well beyond the expected construction timeline and into when the cash flow period is supposed to start on the project. So day one, your target returns are expected to begin distributing, and it's monthly returns here, again, since this a debt style instrument, even though it's a junior participation in the senior loan. And the second part of it, I think, is a really important question. Is Equity Multiple the only senior lender on the deal? The answer is yes. So normally when you go out and get leverage on a deal to boost the net returns to investors, you're bringing in a third-party entity to kind of be your warehouse lender and then prop up the deal. But Equity Multiple is able to use a unique structure here where a Equity Multiple controlled affiliate is the only senior lender, as well as the senior participant and the junior participant. So the junior participant is the piece that we're offering to investors, but Equity Multiple and its principals control all three entities, the senior lender, the senior participant, and the junior participant, which aligns interests in a significant way and protects investors' interests should something go wrong. So I think it's another major plus for the deal as well.
Perfect. Next question comes in about the pods portfolio, asking how often we expect to have distributions given.
I can take that one. So currently for pods, we're expecting to have quarterly distributions to our investors.
Excellent. And then one question just came in about Orland Park and specifically about the sponsor's experience. Millen, can you go ahead and walk us through their experience there?
Sure, no problem. So the sponsor on Orland Park is a group called DMG Capital. DMG is led by two primary individuals, Roger Daniel and Robert Wasserman. Roger has extensive property management experience and has started his own property management company. Previously worked for Village Green and Northwestern Mutual. Rob Wasserman, former derivatives trader, really focuses on debt and equity placement for the firm. They've acquired over 2,000 units since 2018, primarily in Chicago and Milwaukee. Within the portfolio that they've built today, they have an average cash on cash yield over 8% on mostly stabilized assets. They know this market really well. They have extensive local relationships. DMG does have in-house property management, which really helps with vendor management and keeping OpEx low. And we feel really good about their ability to manage and execute on this asset.
Perfect. And then another one for the car wash for Charles there. What is the risk with it, and when do we expect construction to complete? I'd imagine outside of just the completion of the construction risk, what other risks do you imagine?
Yeah, I think it's a good question. I would say the risk boils down to two significant pieces here. First of all, as Daniel mentioned, is your typical construction risk, which I think I talked a little bit about why that's minimized. Horizontal permitting and entitlements already completed at the project. So that phase of development is already done by the time investors are coming into this deal. And then the vertical construction is further reduced. The risk of that is further reduced due to the sponsor's experience in building these very similar type washes before, and B, just the simple nature of building car washes in general. If you think about it logistically, it's really just an office. It's really just one kind of 3,000 square foot office building, and then you're bringing in your equipment, which we have to build your actual structure around the equipment, but it's a very, very simple structure that just houses the equipment where the cars actually go through the washes. The second piece of risk, I would say, is just getting operations up and going and stabilizing. And that's where the sponsors bringing in this new partner's experience, who has over 20 years experience building and operating car washes, is really important. In that our exit is likely going to be tied to getting operations off the ground and running to a certain level. And we feel comfortable on that front because we've run some sensitivity analysis on, even if we miss our numbers by a certain amount, we still feel comfortable due to our low basis that we're still going to get taken out as long as operations do get off the ground. So those are the two, I would say, biggest risks. There's always risk in a deal like this. It's further risk by our position in the deal. Being in the senior loan inherently is just a lot less risky than your preferred equity or equity transactions, especially given it's there is still a ground up component, which we're mindful is riskier than your traditional stabilized deals.
Great. And last, we have one more question about Orland Park. What are the types of buyers that would be interested in buying this? Would it just be another institutional buyer, or are there other parties that we might consider a sale to?
Sure. So given the size of this transaction and an exit valuation of roughly, I think, $7 million, this probably doesn't fit for a lot of your more institutional buyers, but it does cater well to both regional and local operators. And your 1031 buyer, it's actually perfect because it's relatively small. It'll be stabilized upon exit. So we think it's a strong candidate for, a 1031 deal, but also both smaller kind of operators and investors who want, attractive cash flow on a newer asset.
Perfect. Thank you all. That concludes our questions for today. It looks like we're just about out of time. I'd like to thank the entire real estate team. Thank Ashley on the IR team for introducing me. It's exciting to join the team here. Once again, please keep in mind that you must review all important information in the offering memoranda for each of these deals. You can find more information on our website at equitymultiple.com. I'd also like to thank David Lothgren, our producer, for helping us put on this webinar today. Again, any questions, you can reach out at ir@equitymultiple.com. Hope you all have a wonderful holiday season, and thank you for investing with us. Happy investing.